Let's say you tried to time the market and you just missed those days. You miss out on the rest of the rest of the 20% of the gains for the year. Oftentimes when we hear how do you diversify? How do you protect yourself against, market volatility? One thing we hear oftentimes, it's always been said, is, diversify into overseas markets, international markets. And that is still somewhat true, but it's not what it used to be. And the reason that I say that is that the global economy is much more connected than it used to be. Okay? And so the reason that that's so important is you can still, there's nothing wrong with diversifying. Always diversify, and exposing yourself to different sectors is not going to give you as much return, but it's also going to be less risk, right? In case the market does turn on you. With that being said, nowadays, the market is, the global economy is so much more connected that if the US market crashes, the other markets are going to crash too. You know what I mean? It's not like it used to be back in the 70s and 80s, even 90s, where if one market crashes, the other markets pull back, but not nearly as much. Like they react to it, but they don't like fall in tow with it. Nowadays, outside of China, which is the last one that's not like 100% connected, I think that there's better options to quote unquote hedge, right? Now, how do you hedge? Are you talking about equities? Are you talking about other assets? Are you talking about, I don't know exactly what you mean by hedge against a market crash. Will there be a market crash? Well, what's your definition of a crash? Do you mean like the little definition, or do you mean like a pullback? Do you mean a correction? Do you mean a recession? I mean, look at last year. We saw a 25% drop in the overall market, and by end of year, we were up 20% on the year overall, and like 80% from the bottom, or 60% from the bottom. Okay? And that, if you go back in the market, this is something I'll give to you. Every quote unquote crash recovers quicker and quicker and quicker. Because print your go burr, money, transactions, repos, the market is not the economy. People don't understand that the market is not the economy. The market is heavily manipulated and has an inflationary increase unlike anything else in the world. Not even real estate keeps up with it, with equity inflation. Okay? The stock market, the ability for the Federal Reserve to print off 80 billion or 100 billion or 200 billion dollars in a month, give it to banks to dump into a market. In other words, you're adding capital into a market that did not previously exist there, and inflates equities. So look at every crash we've had just since 1994, right? So 2001 dot-com bubble crash, okay? It took 2,648 days to recover. Next recession crash, 1,920 days to recover, 2 years less. 2016, 457 days. Remember 2018 tariff crash? 182 days. Fucking COVID. COVID, ladies and gentlemen. 182 days. 182 days to recover a 25 to 30% drop. It took 6 months to recover the same drop that we had seen, or a similar drop that we had seen in the 2008 crisis that took 5 years. Sure, we are in a massive bull run. We've been in a massive bull run for 13 years. And this could crash at any time. But then the question becomes, how long will it take to recover? So, do you know how many people out there saw the crash coming, sold here because they were like, oh, fuck, it's over, or sold here, didn't know when the recovery was going to come, or didn't believe the recovery was going to come back, and didn't buy back until here? That means they lost as much as 30% of their portfolio and never recovered it because they didn't buy back until almost where it was before. Me, my entire portfolio liquidated on February 24th. So I ended up missing all of this, thank God. But I also didn't start legging back. I legged back in. I didn't jump back in. I didn't start legging back in until almost May. So granted, I was able to actually make a little bit of money because I was able to get out very, very early. Okay? But I missed out on the bottom because I don't know. You don't know when to time it. You don't know when to time it. You just don't. And so the best thing to do is, instead of trying to time it, is to just, if you're concerned, okay, as the market does the, okay, here's what I'll say. What made me get out that day? I had a trailing stop loss because I knew we saw COVID was coming. If you go back in my YouTube videos, you'll see my YouTube video from January of last year where we started watching COVID in Asia and start to make its way to Europe. And we started, the channel was much smaller then, but we were watching COVID and we were noticing it was spreading quickly and we were expecting it to hit the US and to see things that like the reaction. So what I did was I started tightening up my stop losses across my entire portfolio. And that day it kicked out. All right, here's the thing. This is the market. Okay, let's pretend it's just 2021. Okay. Looking back at the all-time, you know, just since 94, you're looking at that, right? And you're like, Jesus fucking Christ, this is going insane. What do I do? Well, if you sell everything now and the market doesn't crash, you miss out on all of this profit, right? If you hold everything and the market crashes, well, now you have to wait for the bottom and then wait for the recovery, or try to time it, but you may not, and you may miss out on all the profit on the way back up. And so, unless you're 1 in a million, you're probably not going to time it perfectly. But what you can always do is, in a bull run like this, you can always start putting cash to the side. Now, nobody wants cash on the side because it's money that's just dying. But when you DCA, right? So when you DCA, when you put money into your brokerage account, or you put money into your 401k or IRA or whatever you do, you can put a little less each time. So instead of putting $1,000 a month, you put, let's say, $900 a month, right? Because you don't want to miss out on the market continuing up, right? But if it crashes, you want to have a protection. So every time you DCA, you can do it, or you do 800 and put a little extra in cash on the side, right? And as you do that, and the market goes, you're building up your capital of cash on the side slowly, okay? And then if the market does crash, rather than trying to sell your shares and time the bottom, you just wait for the bottom, and then when it starts going up, you take that cash on the sidelines and average down the cost. Just buy more of the same shares you have. Because I'd have to go ahead and look at the exact number, but there was back in 2019, 2020, they did a study that said if you miss only the sixth greenest days in a year, you potentially miss 20% of the total gains of the year. Do you understand what that means? What this means is that a good day in the market is what? 0.3%, right? So let's say you have a 10% year and there is, I don't know, 240 trading days, right? And at 10%, you're talking about 0.24% per day average, right? No, that's wrong. I can't fucking do math right now. Hold on. Holy shit, I just blanked out. Shut up. That would be like 0.05% per day or whatever. I don't fucking know. It doesn't matter. So, less than 0.05% per day on average green, right? That means when you have those 2% days or 1.5% days, whatever, the 6 biggest gains of that day, let's say you tried to time the market and you just missed those days, you miss out on the rest of the rest of the 20% of the gains for the year. Okay, less than 0.05%, okay? So you literally miss out on, sometimes it depends on what you're in. If you're I'm talking about the overall market, okay? So, in some cases, like if you're in tech, it could be as much as 30%. I'd have to find the chart because I need to, because there's always gonna be one person who'd be like, oh, that's the bullshit, show me the proof. So you're right, that's fine. I totally, I'm just pulling this out of memory. I have to look it up to back it up. You're right anytime somebody pulls numbers out of their ass, you should always question it. I'll look it up and find it, but this is why it's so important to not try to time it. Actually, let me look it up real quick. Okay, here you go. So it invested since 2000, right? And this is including this is a long time to look at, but if you were fully invested in the S&P and you went through all of the recessions, all of the pullback, the 2001 .com bubble, the 2008 recession, 2000 COVID, your $10,000 would be at $32,000. That is a 6% annualized performance. Okay? Just missing the 10 best days since then, you missed 66% of the profit. That is only 10 days in 20 years. Okay? 20 days, you're basically even. That means there are 20 days in 20 years that are the difference between this. And that is why I tell you it is so important to not try to miss out on, or to try and time this, okay? Here's one from 1999 to 2018. Same thing. 10 best days, almost exactly the same. And this is through the dot-com bubble as well. This is why it's so important. You could literally have only missed 20 days in 20 years, and you're red. This is why you do not try to time your long-term investments. Do not do it. This is what will happen. Now, sure. Well, but what if I time missing the biggest red days? Well, obviously we could play devil's advocate all you want, but that is just why it is so important. Oh, by the way, guys, do you know why I tell you all the time to just put your money in the S&P and fucking forget about it? Look at this right here. The average equity investor, 5.29%. Just sticking it in the S&P and forgetting about it. $120,000 difference. Putting it in VU versus trying to choose your own stocks. That is the difference. Or VTI or whatever the fuck you want, okay?